I do believe that there's a widening gap between pro forma or hoped for EBITDA than real EBITDA. And as EBITDA falls, then buyers' expectations move immediately, sellers' expectations move a little slowly. So someone can go out and start looking for refinancing or selling at one hoped for structure, only to find that the buying market tells them it's slightly different.
Welcome to the Private Equity Value Creation Podcast, where we interview leading investors, operators, bankers, and advisors to help you answer one question: how do we increase the enterprise value of our companies? My name is Shiv, and each episode I will dive deep with a guest to help you become a better value creator and capital allocator. So with that said, let's jump right in and let's get started with today's episode. My guest today is Brian Boorstein, and he is the co-founder and partner at Granite Creek Capital Partners. And what's really interesting about the conversation with Brian is that we talked about how they are not married to one specific type of deal or structure when they're looking at investing in companies. And it's very different from what I hear from a lot of private equity investors that have a laser focus or intent on deploying a certain amount of dollars in the form of equity in their investments, and then debt being a certain proportion of that, or they're very focused on certain industries. And that approach has benefits because you really tell the market what you're about and what types of companies that you would be the best fit for. But Brian and his firm have taken a different approach by leveraging structure as a competitive advantage, and that has allowed them to invest in many other types of companies, which I think would often get ignored or overlooked by some of those other firms that are more focused in specific areas. So it's a really interesting conversation, and I actually think Brian's approach is likely giving them deal flow that other firms are just not able to access because they've already told their LPs that these are the kinds of companies that we're investing in. And I found that to be super interesting and something that a lot of private equity firms can learn from. So with that said, I'd love you to kind of hear the conversation and take a lot away from Brian's wisdom there. And I hope it helps your firm as well. Thanks a lot and enjoy the episode. All right, Brian, welcome to the show. How's it going?
It's going well. How are you?
Good. Excited to have you on. So why don't we start with your background in Granite Creek, and then let's go from there.
Okay, my background, I've been in private equity for 36, 37 years now. Started in the mid-'80s in a place called Golder, Toma and Cressy, which is the precursor to GTCR. And then I started the private equity arm for Heller Financial. We call it Heller Equity Capital Corporation. I left there to get into a more entrepreneurial setting, into something called Dakota Capital Partners, which we were then independent sponsors, but that was even before the term independent sponsors was around. It wasn't even fundless sponsors. We were just deal people, deal guys. And then after Dakota, I did it on my own for a little while, but then I founded Granite Creek Capital Partners with my then two only partners, Mark Radzik and Peter Lehman. Granite Creek has been around for 20 years now. We are a buyout shop. We're actually a multi-strategy firm. We have three private equity funds. The first one is resolved now, still invest. The second one is still up and running, though we're not making any new investments out of it. We're doing add-ons to the portfolio. Third fund is continue to invest. We also manage a fund that invests in control and minority equity of agribusiness companies, more upstream businesses, things that are closer to the farm than the table. We have raised and managed a company. It sounds similar, a fund, that buys and improves farmland. Most of the farms that we own are in Illinois, some are in Indiana. And what we do is buy B and C properties and bring our knowledge of seed selection, investing in the land, and knowledge of chemicals to make yields improve, and then sell them at A and B prices. And then separately, not in a fund structure, we started a company from scratch called Renovo Financial. It is a lender to experienced rehabbers of single family and multifamily homes. And we literally wrote the business plan in 2011, and it's grown exponentially. This year we're on target to originate something about $3.5 billion in loans, half a million dollar average loan size. So we try to take an entrepreneurial approach to investing. Sometimes you could think that we look somewhat like an aggressive family office. Sometimes we are acting like independent sponsors, but in a funded environment. And the breadth and depth of what we look at kind of reflects that.
Yeah, that's one of the things that jumps out is just how broad some of the investments that you're making here are. Some are in the finance space, agriculture, like you mentioned. I see insurance. So what's the common thread? Like, how are you filtering through these companies or figuring out where you kind of want to deploy your capital?
Sure. So the common thread is that that the companies at least start as middle market or lower middle market companies. And we do that for a number of reasons. One is it fits the size of the capital that we have. You do what you do in this business as your source of capital, and so our sources of capital do two things. One is they target the small to middle market companies, and they allow us to bring flexibility in the securities that we hold. To the size, it's not just the amount of money or the amount of EBITDA that they generate. We spent the last numbers of decades thinking about and worrying the issues and the problems that small to middle market companies have. Those are different than larger size companies. In these, we play many different roles. And one day we may be a finance person, one day we may be a corporate coach, one day we may be a psychiatrist, one day we may be an operator, one day we may be a strategist. But those companies usually have not had much institutional capital, or at least institutional growth capital. Usually they've had borrowings from banks. But we come in, we worry about scaling of the businesses, growing the C-suite, making sure that the talent matches the opportunity, matches the amount of cash. So I always look at it as a tripod. You need to have these things, each leg standing around. If you have too much money and not enough management, you better straighten that out. You have too little management and too many opportunities, you got to straighten those things out. So we try to find a good balancing act there and make capital decisions, personnel decisions along those lines.
Yeah, and I guess I get the starting point and the check sizes that you can write and the profile in the lower middle market.
Yeah.
Once you're investing in these companies, doesn't it become a bit of a challenge when you have such a different profile or portfolio companies kind of across the board in different industries? Like, how do you manage complexity at that level?
That's a very good question, because it is complex and it is different. And one of the things that we try to do is early on, as we're assessing the deals, we'll either reach out to people that we know or beyond people that we know to get some expert advice. We typically refer to them as river guides. So we're going to find somebody who has been in the industry far longer than we have, to be able to help us understand the diligence, the opportunities, the risks. We usually come up with a pretty long list of what you need to believe. And that's going to cover what you need to believe, not only to make the investment, but to oversee the investment and ultimately exit the investment. As things have gone on, though, we do become somewhat knowledgeable as investors and somewhat as operators too in certain segments. So agribusiness, for one, as I alluded to, came out of a number of investments that we made, and we began to develop true insight and true contacts. And then we mirrored that up with people who have owned and run and sold their business. We brought them into the GP. So we can go out there and source deals with the knowledge that we have. We can do diligence like we've always done by bringing in experts. But now in that fund, we have people who have been lifelong participants and investors and operators that find the deals for us, help us diligence them, but also bring value add in terms of business development, finding other people as we go along. And we can do that in the range of industries that we're into. We're very operational focused as a team, not necessarily as the individual members. And so we try to bring that in. It really comes with a very simple idea. Small and middle market businesses, they need capital and they need people. And we try to bring both of those to the table.
Yeah, it's really interesting. In a way, it's a form of as an investor looking for, in quote unquote, like product market fit, because you're buying good companies, and over time you develop competency, and then there's a learning curve there, and then at some point it becomes almost like a playbook that you can rinse and repeat across other companies as well.
And the rinse and repeat, again, and just to go back to what the focus is, the rinse and repeat is knowing that where the stress points and the opportunities and the places you need to polish the gem for smaller middle market businesses. If you're dealing with $1 billion companies, financing's different than it are with companies that do 5 to 10 million of EBITDA. M&A transactions are different. The building out of some of the systems so that you can scale and advance are different, and that's where we spend a lot of our time.
Yeah. Talk about structure. So when you're buying these companies, are you mostly coming in as a majority shareholder, or are you buying out the company entirely, or as a minority investor?
So as I touched on, we have multiple strategies, but let me just focus on what we're primarily known for, which is our buyout funds. What is maybe more unusual or a throwback to what it was years ago, we overtly raised our money to be flexible in the securities that we hold. We can do control equity, but we'll also do minority equity. We'll do sub-debt. We'll do preferred stock, common stock. We've done senior debt. Doesn't look like a bank senior debt, but the collateral's there to get security and making us the senior lender. We've done DIP loans. We've done bridge loans. But when we really winnow it down, because we're in the small middle market and we come to the table with $15 to $40 million, if we were to come with all equity, we would usually crush the normal partners that we've got, owner operators. So with the flexible capital that we've got, we would tranche that out. And we will make it so that the incentives and the upsides are far more aligned instead of us owning 99% and they own 1%. So we use that flexibility to structure each deal differently. So every deal has different risks, returns, and upsides and people's capabilities. So we'll create a bespoke structure for everything to reflect the needs and the wants of our partners, which parenthetically have to work with our needs and our wants.
Yeah, so and talk about that a little bit more. So when you talk about these different structures, like when you look at returning your fund as a firm, how much of that is like built on the assumption that part of these structures would be heavily leaning towards debt, because the return profile on deploying capital in that way is very different than on the equity side. So how do you look at that?
So we do look at when we put equity and debt in, we will certainly view the debt and its risks and its upside as that piece of paper, and we'll look at the equity slightly different. But at the end of the day, we don't lose sight of the fact that we have an investment, a global investment that's debt and equity. If we lose $1 of equity or $1 of debt, it's equally as painful. So it's not lost on us. It's just our investment. But the first part of it is, you can't, the last thing that small businesses need are just too much debt. So what we typically do is not over lever the companies with third party debt. So we can put the debt into the company, not have it, crushing the EBITDA to its knees, but we're not really over leveraging the whole company. We're confident in doing that. We also have the ability, unlike most commercial senior lenders, of going interest only. So while people look at the fixed charge, the cost of the debt might nominally be higher, but if you're growing and you have less use of cash to pay that debt for a little while, we look at that somewhat as growth capital. So we can marry them together and be the fat middle, if you will, of the transaction in a small middle market company, knowing that we have the capacity to close with just the money sitting around the table, and we've got the ability to control most of the capital structure. If we have to take out the smaller senior debt because there's problems, we'll do that. If we have to be more patient on the debt, we'll do that. And then if we tranche it out with debt versus equity, as I alluded to before, our partners who either are rolling some of their holdings in or writing checks, it's more meaningful, right? So if we can still come with a sizable check in total, but tranche out more into debt than equity, then they can own more. When we look at the fat middle, I always proverbially call it, we invest in equity. So our debt is really more coming from the equity part in mindset versus a lot of senior stretch lenders or one-stop shop guys who will start from the debt in their mezzanine will be more debt-like.
Mm-hmm, mm-hmm. Why don't more PE firms take this type of an approach? Is it just because of the way they've set up the fund, where they are less flexible in different structures that they can deploy?
I think there's two things, and I can't really answer for everyone, but I'll tell you what we think. Right? It gets back to what I said earlier. You do what you do as your source of money. So if you're going to go out and raise money and you say, I'm going to be a control equity investor, you're going to be a control equity investor. If I go out and say I'm going to be, mostly a credit or a mezzanine investor, then the returns you're probably seeking, as well as the terms that you're going to get in the deal, you're in a creditor agreements, all those various things are going to be more debt-like. If you're a unitranche person, you'll look the same way too. We've really come from it that we can be flexible. Our backgrounds are in control equity. We don't have a problem being a sponsor, whether we're the sponsor from the control side or a sponsor or the first institutional investor or only institutional investor will be a sponsor even in a minority position. So it's a lot more work that we might do because we're really offering up, even when we're minority investors, a lot of the time and effort and experience that we've got as sponsors. But it takes up some time, and it's just a different time and intention in the various companies.
Right. Yeah, I think you have to kind of be proactive on what I'm hearing from you is more at the stage when you're actually raising the funds from LPs that the decision is already made.
Yeah, I mean, look, if we would go and we would put the stake in the sand and saying we're going to be senior lenders, and we wind up doing venture deals, it's not exactly what they signed up for. What we did is to say, here's our backgrounds, and in the middle market segment, it's not as clear. The lines of demarcation between where senior debt and mezzanine start and stop, or mezzanine and preferred stock start and stop, or any of those sorts of things. So we leave it somewhat fluid. Again, trying to structure it so that we're not over leveraging the company or bringing it to its knees, and also making it work to marry up with the reasons why we're getting into the deal, whether it's growth, a buyout, recap, working capital, whatever it might be.
Right. Yeah. Do you think the pigeonholing that happens inside other PE firms when they're saying We want to be control investors. Like
Yeah.
almost prevents them from investing in good deals because there are a lot of these companies that are in the middle market that are profitable, that
Yeah.
are just solid businesses
Yes.
that I think get overlooked simply
Yeah.
because of structure.
Yeah, it's structured, but again, it's because they told people they're going to do that, so they have to structure it that way. I think what happens then is, in times when the control equity people who said they're going to do certain deals, and it gets frothy, so they can't buy and they don't do them. They move down in size, right? So they solve the promise that they made if they were going to control equity, but instead of doing a $100 million deal, they do a $50 million deal, and they probably then over equitize it. It's safer. It's tougher to get the returns, but it's safer. So I don't know if they're pigeonholing themselves or they're doing the right thing, but they have to answer to the promises that they made. Otherwise, they're not going to get their money next. And from our standpoint, it sounds like our funnel is very, very wide. And it is. We hate to see a very, very good company go by because we were unifocused in what we had promised. Some of the best deals that we've had are finding phenomenal entrepreneurs who were never going to give up control. We couldn't walk in and say, "Oh my God, it's your lucky day. You've done all this great work to put this thing here. We'll now be in charge." So we've invested in some of America's greatest entrepreneurs had outsized returns because we were able to make our flexible structure work with what they wanted, and we were happy to be along with the ride. The only issue in that is at times if we want to get out and nobody else wants to get out because we don't have control. And we've proven in many different strategies to be able to get out. Don't get me wrong. The best way of getting out is we all hold hands at the same time and jump off the cliff and we land in the water perfectly nice with a nice splash. That's the best, but it doesn't always happen that way. And the trick then is to make sure that we have the right contractual rights and really the right reach into the market to be able to get out alone if we want to or need to.
Yeah. Do you see that with the types of companies that you're investing in and these different structures, like do you find that you've been able to take advantage of macroeconomic trends like that was much easier to come by 5 years ago
Yeah.
or 4 years ago. Now it's harder, and about a year ago the interest rates were much higher than they are even now, right? So how have you been able to capitalize on that?
Yes. And I think the best example is 29, 2010. When the Great Recession was happening. So when that happened, probably the biggest change was that the debt market seized up. So the traditional senior lenders, instead of extending the multiples of credit that they were pulling in their horns, and that created an opportunity for flexible investors like us to be just below them. So either they wanted to get refinanced out of their holdings to a degree, or they weren't extending the credit to the new deals that allowed us the opportunity to fill the void. I think that was a big impetus for the private credit markets to come in. We had already been doing that, but we would find some senior lenders that said, boy, the EBITDA is down. We're getting a lot of pressure from the regulators. If we could get down to, 2 turns of capital, it'd be great. So we would say, fine, we'll pay you down. And so we were now taking what was the day before senior debt risk, but we were able to price it like mezzanine and equity because the macro environment got the commercial bankers to have to pull in their horns a little bit.
Have you seen more deal flow in today's market with I know LPs are trying to find liquidity. Companies are harder to exit.
Yeah.
Are you seeing opportunities come up there because you have more flexible structure within your firm?
I'll parse that real quickly. There are a lot of opportunities. There's not a lot of closings. And so, yes, there's always need for capital. That's why, broadly speaking, I think a lot of capital has been raised. but buyers and sellers aren't necessarily seeing eye to eye, given all of other macro things that are going on. How do you underwrite companies that are going to be affected by tariffs until you know how they're affected by tariffs? How do you underwrite companies that may be in the face of some of the Doge things that are going on? I do believe that there's a widening gap between pro forma or hoped for EBITDA than real EBITDA. And as EBITDA falls, then buyers' expectations move immediately, sellers' expectations move a little slowly. So someone can go out and start looking for refinancing or selling at one hoped for structure, only to find that the buying market tells them it's slightly different.
Right. Yeah, that makes total sense. Let's shift focus a little bit. How do you support your companies as you're coming into investments? And does that vary based on the structure that you've deployed, whether it's more debt, whether you're a minority investor or control?
That's one of the banes around here, to tell you the truth, is we really should be doing a little less work if we're more debt heavy than we are equity heavy. But, again, our backgrounds, it really one of the things we're trying to sell and bring to the management teams is we're going to be an augmentation of what they do. There's some things that they will always do and always do better than us. Some things that we do day to day, dealing with the banks, financings, sometimes dealing with the auditors. There are times that, some of these companies are still graduating into more sophisticated areas. We try to polish the gem by, moving them into those areas. So we're happy to work fairly closely with them. Yes, and the ones that we control, that is for sure the buck stops with us, our job. But even ones that we're minority holders, it's our tendency to get in, roll up our sleeves, and help them. In small businesses, in small middle market businesses, we'd like to say we back a management team, but usually there's a really strong, two people in the C-suite. We help them with recruitment of more upgrading if it's going to be. And that's a big part of it. So, one of the things that we really primarily care about, people. Mm-hmm. So hiring and firing if that needs to be, upgrading, capital expenditures, which is a little bit of an outflow of a better more intense budgeting. And then what are you going to spend capital on? Financings too. Obviously, that's how we started. That's what we do, and then ultimately acquisitions, dispositions, liquidity. Those are the big things that we spend our time on. We can help and suggest some systems changeovers, but we're going to hire somebody to go do that. And then there's just sort of like being outside of the forest and the trees, right? Sometimes. They have been they're phenomenal salespeople, but they may be, overlooking some other things that we help see them and, identify that and polish them up.
Is it practical to be putting in so much time when you're more debt heavy on an investment? Because it's like the returns, you're putting in a lot of operational resources when you're getting that involved, aren't you?
Yeah, that's again the part that's the bane. So, it's hard to say, only a handful of times we have been only debt or without the upside. So we are not underwriting our debt investments as just necessarily an interest rate return. We're looking for our total investments to be multiples of the money. So somehow we have the aspirations that they're all going to turn into equity. The difference in time, though, admittedly, is somewhat correlated to the size of the company, the development stage it's at, as well as how developed is the entire C-suite. So usually the ones that are larger have had the capital and the time to have more of the C-suite filled out. We can spend less time at that time, and even in companies that we control. So really, and we talk about it. How much time is this quote project going to be? Mm-hmm. But other times we'll find just the best business, and it needs some help. And if it can break through, it's phenomenal. So we've had success with people that we knew didn't have a fully developed business and all the disciplines around. We came in, we didn't have control. We came in and we made a market difference, and the returns are as if you had control.
Do you ever have situations where you've invested with debt, you put a debt facility on, or that's the main source of investment, and then because you've built a relationship and gotten in with a high quality business, it's translated into a future round where you're investing more with equity and get to be a bigger part of that business, where
All the
maybe it would
time.
have been harder otherwise?
All the time. All the time, yes. And part of it is again getting back to the needs that and the wants of the partner. Some people come to us and say, we want only debt, and we'll say, well, you probably don't want to leverage it that much. Take some of it in equity, and then as you go forward, we've got dry powder, and then we figure out what it is. They kind of see that if we work together, that we're not just a lender, but we're a value-added player. And then they say, okay, well, we need more equity. They come in, and it happens. It happens all the time. It's not everything. We don't come in everything with completely pre-prescribed what's going to be. Part of this is you don't know what acquisitions may come down, add-on acquisitions may come down the pike, or where you may fall short and you need to shore up the balance sheet with more equity.
Yeah. What I find interesting about that is a lot of private equity firms are often talking about finding deal flow and more places to invest capital. But in a way, your flexibility on structure and having different facilities to deploy enables you to find more deals and more deal flow. Whereas if a firm is more rigid, it's harder to find the exact deal that meets the profile of what you're looking for. And so you've kind of self-selected into lesser deal flow.
There's a flip side of that too, though. If you out there telling everybody that we'll invest in every quadrant, do you imbue in the mind of the bankers, the deal sources, what you are? So if you'll do anything, then you're lost. So what we really try to say is, we've got the capability to do it, but really think about that company, that company that needs to know it can have that fat middle that I keep referring to close. The senior debt, we can usually always go get senior debt. But if you're looking for the junior capital on down, sort of a one-stop shop if you need it, that's where we shine.
Right. Yeah, I think that's fair as well, because on the flip side, if you just say this is exactly what we do, you almost look like a specialist firm, and then you end up winning more of those deals. So I think that's a bit of a trade-off. Yeah.
And if we were just packaging people, right? People wouldn't always packaging people, and deal flow comes from that. We're kind of known as we're sort of known as using that flexibility to solve the issue at hand of closing and growing.
Yeah, that's really good advice, and I think a lot of PE firms listening could benefit from that. And as we're coming up on time here, Brian, if there are firms listening or founders listening, what is the best way that they can get a hold of you?
We have the website. You go to our website. Obviously, is www.granitecreek.com. My email is brian@granitecreek.com. And again, you never know what's going to come across the transom. So we look at everything. So anyone who's out there who has an equity need, a debt need, a growth need, and you're a middle market business, we've been around for a long time. So obviously we have to do as we say. Track record, our returns have been very strong. So we're good at helping founders and owner operators take their business to the next level. We do try very hard and work with them so that we're building for perpetuity. We want to be able to go and sell to the next person. We want the next person to make money, because that way, if we have that track record, then everybody knows that we're doing that, and that it's reasonable for them to come and pay us for what we've done, because then they can make money too.
Got it. Yeah, that's awesome. And we'll be sure to include the website and your email in the show notes. And with that said, Brian, thanks for coming on and sharing your wisdom. I think really interesting to learn about how you're leveraging structure as almost like a competitive advantage in this marketplace and driving value for your LPs. So thanks for doing this, and appreciate you coming on.
Thank you for having me. I appreciate it too.
Thanks for listening to today's episode. Before you take off, just a few requests from our side. Number one, if you haven't done so already, please subscribe to the podcast on iTunes or Spotify or YouTube or wherever you go to listen to your podcasts. Number two, if you are in the market for due diligence services, strategy consulting, or fractional CMO services, please get in touch with us at www.howtosas.com. And third, please buy a copy of my new book, Exit Ready Marketing. It covers a ton of concepts that we take our customers through, private equity investors, B2B companies, CEOs, operating partners, and marketers. And there's a ton of great value in there that expands on my previous book, Post-Acquisition Marketing, as well. So with that said, I hope you enjoyed today's content, and we'll see you on the next episode.